Have you ever heard the story of Ronald, the janitor who had $8 million in savings when he died in 2014? Yes, you heard that right. A janitor with $8 million. And no, he didn't win the lottery or inherit that money. He simply saved and invested consistently throughout his life, letting the power of compound interest do its job. The moral of this story is that your behavior with money is often more important than your intelligence. Even if you don't have a degree from a prestigious university or don't work at a big bank, you can still become wealthy by having healthy financial habits. Financial success isn't an exact science. It's a behavioral skill where how you act matters more than what you know. This video brings you 5 powerful rules from Housel's book, The Psychology of Money, that will transform how you handle your money and investments. So without further ado, let's dive in. Rule 1. Pay the price. Imagine you want a new watch, a really nice one. You go to the store to look at your options, wanting something that will impress your friends and the girl you're seeing. Now you have a choice. Either you pay for the watch or you steal and run. After all, you're in good shape, right? But I bet you would choose the first option. No matter your physical ability, you'd pull out your card and pay, just like any sensible person would. The point is, you understand that having a watch comes with a price, a fee you need to pay. It's the same with investing. Investments also come with a price, but most people aren't prepared to pay it. That price is called volatility. Understand this. Any investment in variable income, stocks, Bitcoin, real estate funds, ETFs, none of them will move in a straight line upward. They're more like this chart. Now the question is, would you hold onto your investments if they lost value for 3 years straight? Because that is the price you pay for high returns in the stock market over the long term. If your answer is no, if you can't stand seeing your portfolio drop 30% in a few months, then stocks might not be for you because the chances of you losing money are high. But if you understand that time is your greatest ally, and the longer you hold your investments, the higher your chances of returns and the lower your risk, then you have a good shot at making money with stocks. Take this stock, for example. In January 2021, it was priced at 44 Brazilian reals. By June 2022, it had dropped to 22 Brazilian reals, a 50% drop in less than a year. By August 2023, it climbed back to 40 Brazilian reals, then dropped to 31 Brazilian reals by October. And by January 2025, it hit 57 Brazilian reals, now sitting around 42 Brazilian reals. Most people would have sold at 22 Brazilian reals and bought back at 57 Brazilian reals. And this is what we call arbitrageur in the financial market. Investors getting swayed by market waves, buying in when prices are high and selling in panic when prices are low, ensuring they lose money. Now, if you're a bit smarter, you'll notice that from 2021 to 2025, the stock is worth roughly the same. So is it worth it? Maybe not. But if you're even smarter, you'll see that the stock is falling upwards. Each drop is smaller than the last. Over the long term, this is what happens. A stock that was worth 15 cents in January 2000 is worth 42 Brazilian reals today. If you had invested 1,000 Brazilian reals back then and just left it, you'd have over 3 million Brazilian reals today. But looking back is easy. The hard part is holding your investment for 25 years without touching it once, not knowing whether it will rise or fall, and even harder, continuing to invest every month regardless of market ups and downs. For example, if instead of investing 1,000 Brazilian reals at once, you had invested 200 Brazilian reals per month for 25 years, you'd have around 2.8 million Brazilian reals now. But don't be fooled. This wasn't free. Every investor faces volatility, and you need to see it as the price you pay for a brighter future. Rule 2. Enough is enough. Here's an interesting phenomenon. If you give someone a 100,000 Brazilian reals bonus, they'll feel satisfied until they find out the person next to them got 110,000 Brazilian reals. Then they'll spend the entire year frustrated. Capitalism is great at 2 things: creating wealth and creating envy. The desire to outdo your neighbors, friends, and colleagues can drive you to work harder, which can be good. But this social comparison can also make you feel like nothing is ever enough. For example, to be in the top 1% of earners in Brazil, you need to earn around 23,000 Brazilian reals per month, about what a specialist doctor, let's call him Pedro, earns. With this income, Pedro can live a wealthy lifestyle in Brazil, take long vacations, change cars easily, and outsource chores he doesn't like. He feels good about what he's achieved until he buys a vacation home in Angra dos Reis and finds out his neighbor is Roberto, a CEO of a publicly listed company earning 1.6 million Brazilian reals per month. You'd think Roberto would be satisfied, but he's childhood friends with Neymar Jr., who is in the 1% of the 1% of the 1%, with a fortune of around 2 billion Brazilian reals. Compared to that, Roberto's 1.6 million Brazilian reals per month suddenly feels like pocket change. And doesn't stop there. Neymar sometimes attends celebrity parties where Jeff Bezos shows up, someone in the top 1% of the 1% of the 1% of the 1%. In 2024 alone, Bezos added $69 billion to his wealth, reaching around $220 billion. There will always be a bigger fish. This type of envy has led many people to make terrible mistakes. Some leveraged themselves to the limit to try to climb the wealth ladder and lost everything. Some ended up in prison for insider trading, and others destroyed their families. If you're learning to manage your money here, it's likely that at some point, you'll achieve a level of financial freedom most people can only dream of. But you need to accept that enough is enough. Don't trade what you have and need for something you don't have and don't need, even if you think you want it. Rule 3. Nobody is crazy at first glance. It might seem like people do crazy things with money. Some spend absurd amounts on absurd things. Others hide cash under their mattresses. But remember, people come from different backgrounds, childhoods, parents, life experiences, and levels of education. All of this shapes different values and perspectives. What seems crazy to you might make perfect sense to someone else. For example, 21% of low-income families in Brazil spend over 100 Brazilian reals per month on gambling, slot machines, scratch cards, lotteries, sports betting. At the end of the year, that's over 1,200 Brazilian reals. Yet, 63% of Brazilians can't save even 200 Brazilian reals per month, and more than half couldn't cover a 1,000 Brazilian reals emergency without borrowing. It sounds crazy, but for many living paycheck to paycheck, buying a lottery ticket isn't just a gamble. It's a piece of hope, the only perceived shortcut out of hard life. But hope comes with high interest rates, and those who can least afford it often pay the highest price. Try to see things from their perspective. Most live on tight salaries with no room to save, lack good education, have no clear career prospects, can't afford vacations or new cars, and can't put their kids through college without going into debt. Buying a lottery ticket is their way of buying a dream many middle and upper class people already live, which is why the poor buy more lottery tickets than the rich. So, maybe they're not that crazy after all. But how does this make you a better investor? By recognizing that we're different, you'll be less tempted to copy someone else's investment strategy that doesn't fit your goals. For example, your risk profile might be more aggressive than a billionaire's because your goal is to get rich while theirs is to stay rich. Copying a billionaire's portfolio may be completely irrelevant for your purpose. Recognizing these differences helps you say no more easily, especially to investments outside your circle of competence. If you don't understand what Bitcoin is or how stocks and market cycles work, don't get involved. The rule is simple. If you don't understand the game, don't sit at the table. Understanding other people's perspectives, or at least accepting that there are different ways of seeing the world, helps you navigate society and stay on your path, not someone else's. Rule 4. Don't try to predict the future. What do the Great Depression, World War II, financial crises, and COVID-19 have in common? All of these events shaped society, had massive impacts on financial markets, and were almost impossible to predict. Nassim Taleb, a mathematician and risk analyst famous for studying the unpredictable, calls these events black swans. A black swan is an outlier event that nothing prior convincingly indicates could happen, has an extreme impact, seems obvious only in hindsight. Human nature tricks us into thinking we should have seen it coming, but that's almost impossible. Remember January 2020, when markets fell almost 50% in a few months? Were you one of those screaming to sell because the market would never recover? Or did you stay calm and maybe even invest more using your emergency fund? If you stayed calm and invested more, not only did you show strong emotional control, but you also ended up at least 50% richer. Here's a fun fact. If you had invested in WG stocks 20 years ago, your return would have been over 6,900%. But if you missed just the 10 best performing days, your returns would drop by 60 to 80%. Trying to predict the best time to enter or exit can be very costly. In practice, it's time in a market, not timing the market, that builds wealth. The lesson here, it's more useful to prepare yourself mentally and financially for unpredictable disasters than to try to predict them before everyone else. Stop listening to macroeconomic predictions. The events that will truly shake investors in the future are precisely those that no one will see coming. Rule 5. Beware of pessimism. If I gave you a list of reasons why Bitcoin could crash by the end of the year, heavy regulations, the U.S. Federal Reserve raising interest rates again, or mass sell-offs by governments, you'd likely pay attention and believe Bitcoin is doomed. But if I gave you reasons why Bitcoin could keep rising, big institutional funds buying more, record numbers of wallets holding over one Bitcoin, or increasingly scarce supply due to halvings, you'd probably shrug and think they've said that before. I don't blame you. We all know pessimism sounds smarter, while optimism seems naive. But have you ever wondered why? Daniel Kahneman, author of Thinking Fast and Slow, explains that this bias is evolutionary. Losses feel much heavier than gains, and organisms that treat threats as more urgent than opportunities are more likely to survive and reproduce. It makes sense. If you were a hunter-gatherer 12,000 years ago, would you ignore a moving branch in the bushes and risk being dinner for a predator? Or would you assume the worst and run, even if it was just the wind? I think I know your answer. That's why we listen to pessimists more carefully, not just out of instinct for survival, but also because progress is slow while setbacks happen quickly. Progress rarely happens overnight, while disasters can occur instantly, making it easier to create dramatic narratives around them. Optimistic stories about the future require looking at longer time frames, which can sound vague and less exciting. But knowing that you're inclined to be more captivated by pessimism can help you recognize this bias in the future. To conclude, when you won't get rich in the stock market without paying the price of volatility. 2. Envy is one of the worst sins. Don't risk what you have and need for what you don't have and don't need. 3 different perspectives lead to different decisions. For instead of trying to predict disasters, prepare yourself mentally and financially to survive them. 5. Be cautious with investment advice. Pessimism appeals more to our survival instincts than optimism. I hope you enjoyed this video. If you made it this far, comment banana, and I'll see you in the next one.